In the year 1825, global markets experienced their first modern financial crisis that ultimately resulted in bank failures, stock market capitulation, currency crashes, and debt defaults. In the centuries that followed, global events, natural disasters, wars, asset bubbles, pandemics, and regular economic cycles have continued to shake up the capital markets and keep investors on their toes. Asia in particular is no stranger to market crises, and at HSBC Global Asset Management, we have been successfully investing in Asian capital markets throughout various market cycles for nearly 3 decades. Of the infamous list of past crises, the global financial crisis of 2007 to 2008 stands out as one of the most unforgettable market events of our lifetime. What started out as a subprime mortgage crisis in the US eventually brought the entire global financial system to its knees. Global investment-grade bonds peaked at the time when Bear Stearns collapsed, and the market went on to tumble 11% from its peak to its bottom at the end of October 2008. For Asian dollar bonds, the asset class suffered a larger drawdown versus global investment-grade bonds, but the 12-month return on Asian bonds from the trough of the crisis was a lot more compelling in comparison. During the European sovereign debt crisis of 2011, the trend of Asian bonds bouncing back with greater vengeance than their global counterparts replayed itself. There is a trend in past crises of Asian bonds recovering sharply following a downfall, ultimately leading to a strong rise over the longer term and an outperformance versus global bonds. Yet again, in the current pandemic situation, Asian dollar bonds were relatively resilient and experienced a smaller drawdown when compared to its global peers. There are a number of reasons that can help explain the resilience. For one, the Asian dollar bond market has seen phenomenal growth just in the past 10 years. China has become the largest component of the Asian bond market, and many Chinese issuers are government-related entities, which is a positive for stability in today's environment given the strong government support. Credit quality of the market is also relatively high, with an average credit rating of BBB+, which is a solid investment-grade rating. And from a bottom-up perspective, many Asian issuers enter the year with better corporate fundamentals than in past years, indicating their improved preparedness to weather the uncertainties of 2020. At HSBC Global Asset Management, we excel at credit selection in fixed income investing. Like with other market events in the past, our credit selection process has provided us with a powerful edge in navigating the COVID-19 crisis. Our award-winning Asian fixed income team continues to stay focused on generating alpha, even in times of market uncertainty.